Welcome to another deep dive. Today, we're really getting into something special. It's an amazing piece of financial history. A letter from Warren Buffett to his partners, written way back in July 1961.
Yeah, it's fascinating. This isn't just some, dusty old document. It's like a direct window into how he thought and operated right at the beginning. We see the foundations being laid.
Exactly. The core principles, the operational thinking, it's all starting to crystallize here. You really see the seeds of his later success.
That's right. And this specific letter, it gives us this rare glimpse into the Buffett Partnership, LTD,
Yeah.
back then. And it captures this really key moment where he was looking to uh, consolidate all his different partnerships into one.
So our goal today is pretty clear. Let's unpack this thing. We'll pull out the key nuggets about his performance philosophy, how he structured things, basically how he built this unique investment vehicle.
Perfect for anyone wanting to understand that core long-term investing mindset.
Okay, let's dive in. So first off, why this letter? Why a mid-year update? I gather the partners were getting a bit thirsty for news.
Yeah, that's pretty much it. Buffett actually uses the phrase, a long time between drinks, to describe how partners felt about just getting one letter a year. So
Mm.
it really shows even that early on, he understood the practical need for uh, transparency, regular communications.
Building that trust, right, keeping investors in the loop.
Exactly, even with a smaller group back then.
Okay, let's talk performance. First half of 61, how'd they do?
Well, the letter says Buffett Partnership, LTD, did moderately better than the Dow Jones Industrial Average. The Dow was up about 13%, including dividends, and the partnership edged that out.
And the newer partnership started that year.
Yeah, they also matched or slightly beat the Dow from when they started. So, on the surface, pretty good results.
I sense a but coming.
Oh, yeah, a big one. This is where it gets really interesting, I think.
Okay.
Right after reporting those numbers, Buffett basically slams on the brakes. He makes
Yeah.
this huge point about not judging performance over short time frames. He literally writes, "One year is far too short a period to form any kind of an opinion, and measurements based upon 6 months become even more unreliable."
Wow. Okay, so setting expectations early.
Totally. He wasn't interested in short-term bragging rights. His focus, he says, was on 5-year performance, ideally seeing how they did in both up and down markets.
That really tells you something about his long-term view right from the get-go.
Absolutely foundational.
And he didn't stop there, did he? He actually warned them that performance might lag if the market kept climbing fast.
Yeah, which is kind of counterintuitive after reporting good numbers, right?
Yeah.
He doubted they'd keep beating the Dow if the market continued that strong H161 run.
Mhm.
He even suggested they might fall behind the average.
Why? What was the thinking there?
It boils down to his value approach. He explained their holdings naturally become more conservative as the general market level rises.
Okay.
Meaning as stocks get more expensive, he's finding fewer bargains, so more of the portfolio shifts towards things that are less correlated with the overall market's day-to-day swings.
Protecting capital.
Exactly. He wanted a chunk of the portfolio, at least partially insulated from the behavior of the market, and that chunk grows as the market goes up. He's that great phrase, more of our portfolio is not on the stove.
Huh. I like that. So less is cooking when the market's hot.
Precisely. It's that counter-cyclical thinking, being prepared, not just chasing returns.
And he also mentioned a potentially major commitment he was starting to build.
Right. And this is fascinating, too. He said he hoped he would do nothing market-wise for at least a year.
Hoped it would do nothing.
Yeah. He saw it as a potential deterrent to short-range performance. Can you imagine saying that today?
Not easily.
But he believed it offered superior results over a several-year period, plus substantial defensive characteristics.
So patience, high conviction, willing to look, frankly, a bit slow in the short term for that long-term payoff and safety.
That's the essence of it. Delayed gratification in investing, established very early on.
Okay, so beyond the performance philosophy, this letter also flags a really big operational shift, right?
Huge. The plan to combine all the separate partnerships into one single entity by the end of the year.
He'd been talking about it, but this letter seems to be laying out the actual plan.
Exactly. He frames it as a strategic move. It would be a lot of work up front, he admits, but would make things enormously easier in the future.
Streamlining. Makes sense as things grew.
Yeah, creating a more efficient, unified structure, setting the stage for more scale down the road.
And the details he provides on this new structure are incredibly thorough. Let's walk through some of those key provisions. First, the merger itself.
Right, point A in the letter. It was structured as a tax-free merger, crucially based on market value at year-end.
Tax-free meaning.
Meaning partners wouldn't face an immediate tax bill just because their assets were moving into the new combined entity. The tax liability on those unrealized gains was deferred until they actually sold their partnership interest way later.
Smart. Avoids creating a cash crunch or disincentive for partners right at the consolidation.
Very considerate, showed real foresight about the practicalities for his partners.
Okay, provision B, the profit split. This sounds pretty central to the whole deal.
Oh, absolutely. And quite innovative for the time. The structure was, first, limited partners get the first 6% return each year on their capital from the start of the year.
A hurdle rate, basically.
Exactly. Only after the partners got their 6% did Buffett, as the general partner, get his share.
And his share was?
1/4, 25% of the profits above that 6% hurdle. The other 3/4 of the excess went to all partners, including Buffett, based on how much capital they had in.
So he only did really well if the partners did really well, significantly better than 6%.
Precisely. And if they didn't hit 6% in a year, that shortfall or deficiency would be carried forward. It had to be made up in future years before Buffett could take his cut of excess profits again.
But not carried back, right? He couldn't lose past profits.
Correct. No carry back, only carry forward of deficiencies.
How did this compare to the deals partners had before? He had a few options, didn't he?
He did. He points out this new single arrangement would be better for partners than the first two options they previously had. There was a third option, though, where this gets interesting. For partners under that specific old deal, the new structure was better, up to an 18% annual return for the partnership.
But if the partnership somehow averaged more than 18% a year,
Then that old third arrangement would actually have been slightly better for those specific partners. But Buffett notes that about 80% of the total assets were under the first two arrangements anyway.
so the vast majority were clearly better off.
Right. And he expressed hope that the minority under the third option wouldn't feel shortchanged, which is, classic Buffett diplomacy.
Okay, Section C deals with losses and Buffett's own stake. This seems critical.
Absolutely critical. First, on losses, similar to the profit deficiency, there's no carryback against amounts already credited to him. Losses just reduce the capital accounts and have to be made up before he gets future profit shares.
Standard enough. But then comes the big commitment.
Yeah, this is huge. He states that he and his wife, Susie, would have the largest single investment in the new partnership.
How large?
Probably about 1/6 of total partnership assets. Think about that. 1/6 of everything. So he says they'd have a greater dollar stake in losses than any other partner or family group.
Wow. That's putting your money where your mouth is.
But wait, there's more. This is the kicker, I think. He says he's inserting a provision which will prohibit the purchase by me or my family of any marketable securities outside the partnership.
So all his eggs in this one basket.
Essentially, yes, for marketable securities. He spells it out.
Hmm.
The new partnership will represent my entire investment operation in marketable securities, so that my results will have to be directly proportional to yours, except for his profit share above 6%.
Okay, that is radical alignment. No side deals, no cherry picking, the best ideas for himself.
Exactly. He eats his own cooking, period. What does that tell you about his commitment to his partners? It's foundational. We talk about alignment of interest now, but he built it in from day one, rigorously.
He also thought about practical needs, like partners needing income, Section D.
Right. He addressed a potential stumbling block for consolidation. Partners could choose to receive monthly payments, basically drawing down against their capital at a rate of 6% per year, or they could just let that 6% accrue and automatically have it reinvested, treat it as an advance payment to buy more partnership equity at year-end.
Flexibility, catering to different partners' cash flow needs.
Yeah, shows he wasn't just thinking about the investments, but the partner's real-life situations.
Yeah.
Very practical, very partner-focused.
Then there's a borrowing provision, Section E.
Partners could borrow up to 20% of their partnership interest value during the year at a 6% interest rate. This loan would then be settled up at year-end, usually against their capital balance.
Why offer that?
He frames it as being for unexpected situation, a bit of emergency liquidity. But he stresses it's not intended that anything but relatively permanent funds be invested. He expected it to be a relatively unused provision.
So a safety valve, but reinforcing the idea that this is long-term money.
Exactly. Don't treat it like a checking account, but we understand life happens.
And finally, Section F, a small but telling detail about taxes.
Yeah, very practical. He says that if there were any small tax adjustments needed on the partnership's overall tax return, resulting in less than $1,000 of tax return, he, the general partner, would just absorb that cost personally,
Incentive.
instead of having to issue amended K-1s and create a multitude of paperwork for potentially 80 or more partners over tiny amounts.
That's actually pretty thoughtful. Saves everyone hassle over small potatoes.
It really is. Again, it shows that focus on making it easy and fair for partners respecting their time. It builds goodwill.
So let's talk scale for a moment. What was the size of this operation in mid-1961?
Well, he mentions the minimum investment for new partners joining would be $25,000, which was a fair bit of money back then.
But not for existing partners merging in.
Correct. And partners could add or withdraw funds at year-end in increments as small as $100.
And the total size of the combined partnership?
He estimated it would be in the neighborhood of $4 million after the consolidation.
Still relatively small by today's standards, but growing.
Definitely growing. And he makes a key point about this scale. He says this size allowed them to consider investments, like that major commitment he mentioned earlier, that they would have had to pass several years ago when they were smaller.
Ah, so scale was starting to give them more opportunities, more capacity for those patient, potentially larger bets.
Exactly. Growth was enabling the strategy, allowing bigger, more impactful positions.
And true to form, he wraps up by inviting questions, right?
Yep. Offers to answer any questions partners have, even says he'll send a supplemental letter if lots of questions come up on the same topics.
Open communication, start to finish.
Absolutely. Transparency was clearly baked in for the beginning.
So wrapping this up, what are the big takeaways for us, for you listening? I mean, digging into this 1961 letter, it's clearly more than just, a history lesson.
Oh, absolutely. It's like finding the original blueprint.
Yeah. We see that laser focus on long-term results, not short-term noise. That disciplined, almost counter-cyclical approach to building the portfolio.
And the sheer ingenuity in structuring the partnership to align his interests so tightly with his partners. That's huge.
It really is.
And I think it also shows this deep commitment to clarity, to fairness. He understood investor psychology, his own included. It really drives home that great investing isn't just about picking stocks, right? It's just as much about managing expectations, managing behavior, structuring things properly.
It's this incredible mix of sharp financial thinking and really meticulous operational design. That's what built the foundation.
Okay, so here's a final thought to leave you with. Think about investment funds or even just personal financial strategies today. How many truly embodies that level of direct, verifiable alignment that all my marketable securities are right here with yours level, and that unwavering long-term discipline that Buffett laid out so clearly back in 1961? Does this glimpse into the past suggest that maybe, just maybe, that kind of simplicity and transparency are fundamental keys to lasting success even 60-plus years later? Something to chew on.